Ladies and gentlemen, good day and welcome to Airfloa Rail Technology Limited H2FY26 and FY26 earnings conference call hosted by Atlas Capital. We have with us management today, represented by Mr. Venkateshan Dakshinamurthy, Managing Director, Mr. Manikandan Dakshinamurthy, Joint Managing Director, Mr. Venkateshan Satish Kumar, Whole-Time Director, Mr. Jay Manikandan, Financial Advisor, Mr. Harprasad Raut, Company Secretary, Mr. Raghavendra V, Finance Manager, and Mr. Rutul Shah from Atlas Capital, company's Investor Relations Advisor. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation continues. Please note that this conference is being recorded. I will now hand over the floor to Mr. Manikandan Dakshinamurthy for his opening remarks, post which we will open the floor for Q&A. Thank you, and over to you, sir. Mr. Manikandan, please go ahead with your opening remarks.
Thank you, sir. Good morning, everyone, and thank you for joining us today. I have with me Mr. Dakshinamurthy Venkateshan, Managing Director, Mr. Venkateshan Satish Kumar, Whole-Time Director, Mr. Jaimani, Financial Advisor, Mr. Haraprasad Raut, Company Secretary, Mr. Raghavendran, Finance Manager, and Mr. Rutul Shah from Atlas Capital. Our investors, relations advisors. I hope all of you have an opportunity to review our investor presentation and financial results, which have been uploaded on the stock exchange and the company's website. FY26 was an important year for Airfloa as we successfully delivered on the commitments and guidance we have outlined. For FY26, we reported revenue of 319.6 crores, representing growth of 66% over FY25. This growth was supported by strong project execution, higher capacity utilization, and improved operational planning. More importantly, we achieved this while maintaining healthy profitability and continuing to strengthen the foundation of the business. The second half of the year was particularly strong from an execution standpoint. As is typical in our business, project execution tends to be weighted towards the later part of the year due to customer ordering and spending patterns. Supported by multi-shift operations and improved project planning, we were able to convert a large portion of our order books into our revenues and deliver on our commitments. Beyond the financial performance, FY26 also marked another step forward in the evolution of Airfloa business model. Over the last several years, we have been steadily transforming the company from a component focused railway supplier into an integrated engineering and manufacturing platform. Today, our capabilities extend beyond supplying individual products to execute complete interiors, assemblies, integrated coach systems, and turnkey projects involving design, manufacturing, supply, installation, and commissioning. We believe this evolution is strategically important as it enables higher value addition, strengthen customer relationship, creates a greater differentiation, and supports long-term profitability. Railways continue to remain our largest growth driver during FY26. We continue to see a healthy opportunity landscape across Vande Bharat trains, Amrit Bharat trains, metro rail projects, EMUs, refurbishment programs, and broader modernization initiative across Indian railways. At the same time, our focus is also on increasing our presence in higher value products and integrated solutions, which we can contribute greater engineering content and create stronger customer engagement. Our metro business also continued to make progress during the year and remains an important long-term growth opportunity. With investment in urban mobility continuing across multiple cities, we believe metro rail and rapid transit systems will remain a meaningful area of opportunity for the company. Coming to the defense and aerospace, FY26 was a foundational year for Airfloa. While the contribution from this segment remains relatively small today, we made meaningful progress in strengthening the capabilities, building partnerships, and evaluating opportunities across emerging diverse defense and aerospace applications. I am pleased to share that the proposed joint venture with Big Bang Boom Solution is expected to be formally incorporated within the next 2 weeks. The objective of this partnership is to combine advanced technology capabilities with Airfloa's manufacturing and execution strength to participate in the next generation defense opportunities. We are also actively pursuing opportunities in aerospace simulation systems and training aircraft, and remain optimistic about the medium-term potential of this segment. Supported by increasing indigenization efforts and broader Atmanirbhar Bharat initiative, we believe defense and aerospace can emerge as an important growth vertical over the long term. While we remain ambitious about growth, our approach continues to be guided by profitability and capital discipline. Over the last few years, we have consciously moved away from the low-margin projects and adopted a selective bidding strategy process focused on opportunities that meet our internal return thresholds. We believe sustainable value creation comes from balancing growth with profitability and disciplined capital allocation. This approach became particularly relevant during FY26 as the industry witnessed significant inflation in key raw materials, particularly steel and aluminum. While many contractors contain price variation clauses, the increase in commodity prices was not fully offset through the contractual mechanism. Despite these headwinds, we maintain healthy profitability through disciplined project selection, cost optimization initiative, supplier negotiation, and improved execution. On the order book front, we continue to maintain a strong visibility. As of May 2026, our unexecuted order books stood at approximately 486.9 crores, providing healthy visibility for FY27. In addition, we have an active bid pipeline of approximately 1,200 crores across railways, metro systems, defense, and aerospace opportunities. Historically, we have maintained a bid-win ratio of approximately 20 to 25%, which gives us confidence regarding the future order inflows and support our growth outlook. We have also initiated the next phase of infrastructure expansion through the development of larger integrated manufacturing facilities. These investments are intended to support future growth, improve operating leverages, and strengthen our execution capabilities across our key business segments. Before I conclude, I'd like to briefly address our earlier aspiration of achieving 1,000 crores in return revenue over the medium term. Over the last years, as mentioned earlier, the operating environment witnessed significant volatility in the commodity price alongside broader geopolitical uncertainties. While the opportunity landscape remained robust, we remained disciplined in our approach and chose not to pursue growth at the expense of profitability. In several instances, we requested customers to retender the project where the economics no longer met our return expectations. Consequently, the timeline towards the 1,000 crore revenue milestone may extend modestly. That said, our confidence in the long-term opportunity remains firmly intact. Demands across our key sector continues to remain strong. Our order pipeline remain healthy, and we continue to see significant opportunities across railways, metro systems, defense, and aerospace. Looking ahead, we are targeting a revenue approximately 500 crores in FY27 while maintaining PAT margin in the range between 12 to 13%. Our confidence is supported by our existing order books of 486.9 crores, strong execution visibility, ongoing capacity expansion initiatives, and a bid pipeline of 1,200 crores. We believe the company is well positioned to deliver another year of strong growth while maintaining its focus on profitability and capital discipline. We also remain optimistic about FY28 and beyond as several initiatives undertaken over the last few years begin to scale. Going forward, growth will continue to be driven through a combination of organic expansion and selective inorganic opportunities that are strategically aligned and value accretive. Moving on to the financial performance, revenue for the year stood at 319.6 crores as compared to 192.4 crores in FY25, representing growth of 66% year on year. As highlighted earlier, project execution in our business is typically weighted towards the second half of the year due to ordering and spending patterns within railway projects. Accordingly, H2FY26 revenue stood at 229.1 crore compared to 107.3 crores in H2FY25, reflecting a growth of 114% year on year. For FY26, EBITDA stood at 64.2 crores, reflecting growth of 33% year on year with EBITDA margins of 20.1%. Profit after tax stood at 39.1 crores, representing growth of 52% year on year, while PAT margins stood at 12.2%. Moving to operating expenses, the increase in other expenses during the year was primarily attributable to higher CSR expenditure, increased bill discounting charges, and foreign exchange related costs arising from procurement activities and commodity market volatility. On the financing side, finance costs declined during the year despite the significant increase in the scale of operations. This was driven by lower processing cost, repayment of select facilities, reduction in delayed payment charges, and proactive supplier management initiative. Our focus on profitable growth and disciplined capital allocation continues to reflect in our return ratios. For FY26, ROE stood at 22.4%, while ROCE stood at approximately 24.9%. Turning to working capital, improved cash conversion remains one of our key priorities during FY26. Receivable days improved by 24 days, while inventory days improved by 48 days. Trade receivables stood at 214 crores as of March 31, 2026. However, it is important to note that a significant portion of the annual revenues were executed during March, resulting in elevated year-on-year receivables, year-end receivables. Collections have remained encouraging post-year end. Approximately 20% of the receivable are already being collected as of May end, and we are expecting nearly 70% of our outstanding receivable to be collected by the end of June. Trade receivables declined modestly despite strong revenue growth during this year. This was primarily due to the advance payment made to certain suppliers to secure material availability and support uninterrupted execution during the peak project execution period. These advances are reflected under other current asset on the balance sheet. From the leverage perspective, the company continues to maintain a healthy and disciplined capital structure. As of March 31, 2026, our net debt to equity ratio remained comfortable at 0.2 times. Overall, we believe the company remains well positioned to support future growth through healthy profitability, improved working capital efficiency, disciplined capital allocation, and a strong balance sheet. With that, we would now like to open the floor for question and answer. Thank you very much.
Thank you so much. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may click on the raise hand icon from the participants tab on the screen. We request participants to restrict to 2 questions and then return to the queue if you have any more questions. We'll wait for the question queue to assemble. Requesting participants to remain connected. We'll take a first question from Paras Chheda of Purple One Vertex Ventures. Paras, please go ahead.
Yeah, thank you, sir, for this opportunity and congratulations for the strong set of results. Sir, my first question is related to working capital cash flows. I mean, as you mentioned that, post the year, 20% receivables have been collected and some 70% balance will be done by June end. So by end of the June, what receivables do we expect to be outstanding then? And when do we expect our, cash flow from operations to turn positive? So that's the first working capital question.
Well, so as I said earlier, first of all, thank you so much for attending our discussion, basically. And actually, as I said earlier, by this month end, we will be receiving approximately around 100 to 110 crores, which will give us a very strong cash flow, number one. And number two, we are expecting this to reduce drastically. In the previous discussion also, I have highlighted the same thing. So it will take at least 3 to 6 months to make it less than around 150 or 160, around 150, 160. So we are already working onto it to make this working cycle around 60 to 70 days instead of 90, 95 days. And the receivable cycle also to reduce around 60 to 70 days. So that is our goal right now. We are working to achieve this. Hopefully, we'll be achieving this in another maximum of 3 to 4 months.
Understood, sir. Secondly, sir, with regards to this 500 crore revenue guidance for FY27, and we've got this quite a strong order book of 469 crores. Now, how much of this revenue guidance is already covered within the order book, and how much do you expect from the future order wins? I mean, what part will be done out of this existing order book and the balance from future order wins to achieve this 500 crore revenue?
Sir, almost 70 to 75% is lying on this financial year, sir. And out of this 1,200 crore order books, which we are now expecting, almost 30 to 40% again is going to be executed in the current financial year. Which means that we will be having a more demand of supplies, for which we need to run faster to achieve this number, what we have projected, which means that we have to supersede the number what we have actually now committed.
Understood, sir. Thank you so much, sir. I'll come back in the queue.
Thank you, sir.
Thank you. We'll move to our next participant. We have Krupa Shankar NJ of Avendus Park. Please unmute your microphone.
Yeah, sir, thank you for the opportunity. Sir, my question is with regards to the order inflow momentum. So you had highlighted about the pipeline of close to 1,200 crores. And sir, could you just give more clarity with regards to segment-wise, railways, defense, etc. From where are we seeing these opportunities, and how do you look at these opportunities panning out for the next couple of years? All right. So that is the first question.
Yes. Sir, the bidding of 1,200 crores is predominantly on the Indian railway sector. Okay. So out of 1,200 crores, almost 900 crores is for the Indian railway sector, spreading towards the Atmanirbhar Bharat coach, Spark coach, and then Kavach coach, and then Vande Bharat sleeper coaches. So these are the major chunk of business which we are now envisaging. Apart from this, metro segments are there. We are already holding almost 70 crores of orders for metros right now. And we are also expecting another 120 crores, which is there in that 1,200 crores for the metro segment.
Okay.
And as far as the defense is concerned, we are expecting an order of around 60 to 70 crores, which is predominantly from HAL, from the order books of 1,200 crores. Apart from this, we are participating in various other defense projects, which is not being included in this 1,200 crores. The reason being is that since it is a first time bidding happening in the defense side, we have not included in this 1,200 crores. So other than that, railways is majorly almost 80% is from the, not 80%, 70% is from the railway sector, sir.
Okay, got it, sir. Sir, so this is for the current pipeline you have highlighted. If you can just give more clarity with regards to how the next couple of years opportunity is going to be. That is number one. And also, you have also stated that there is a joint venture which has been created with Big Boom. So could you just give more clarity with regards to what is that JV, how is that it's going to help us in the medium to long term?
Okay, sir. Sir, our major focus for the next 3 years is predominantly on 3 major Indian railway projects, namely Vande Bharat sleeper platform, Amrit Bharat turnkey contracts, and Kolkata Metro turnkey contracts. These are the 3 major contracts which is going to come, which we are predominantly working on, and which has got a very big chunk of business in the Indian railway segment. Apart from this, we have metro segments and also regional transportation segment, which recently been awarded to ICF from Karnataka government. And very importantly, we have a very major focus on the refurbishment of the coaches, which is a very big business which is about to come in future. So these are the things as far as the railways are concerned. As far as the defense is concerned, we already highlighted that we are working on 2 projects. Other projects are lining up, which I cannot disclose right now. But there are very lucrative projects which is coming on our way through the joint venture and technology transfer.
Okay.
Which I'll be disclosing this on an appropriate time for the defense activities. So when it comes to the Big Bang Boom solutions, we already started getting the know-how from the foreign companies as a consortium. Now, because of internal reasons, we were not able to do the joint venture in the last month. By before the 15th of June, this joint venture is officially getting incorporated. So another 10 to 12 days are there. So before 15th of this month, this incorporation is happening, sir.
Okay. Sir, I mean, the opportunity which can result from this joint venture?
Predominantly on air defense systems, basically, namely, which we have already said that autonomous drones for the defense and the industrial applications, and also the high power microwave laser systems.
Got it. So just to conclude, so the next couple of years, we are looking at somewhere about close to 20-25% kind of order inflow CAGR growth. Is that a conservative assumption?
Yes, it is very conservative, sir.
Got it. Got it. Thank you, sir. Yeah.
Thank you so much, sir.
Thank you. We're taking a next question from Dhaval Pandya of Ariza India. Dhaval, please unmute.
Yeah, hi. Am I audible?
Yes, please.
Good morning, and first of all, congratulations on good set of numbers, sir. I had a couple of questions, but I'll start with one. So, how are we going to fund our growth as the things as such as operating cash flow are in negative and even free cash flow are in negative. Our working capital cycle is also large, so we will need funds to run this. And if we are opting for debt, what is the debt we are looking to put on books for the stated growth guidance for next 2 years?
Sir, thank you for asking this question, sir. Actually, we have tied up with two banks for a debt funding, basically, because we are not going for any equity raise or whatever it is this year. We are having a strong receivables right now. And secondly, we are now going for a debt funding where debt funding of approximately around 120 crores, of which we have already got the sanction for 60 crores, and another 60 crores we are going to get a sanction between 15th and 30th of this month. So which means that in fact, we have got the in-principle sanction also after due diligence. So between 15th and 30th of this month, we are going to get another 60 crores. So we'll by the end of this month, we'll be having around 120 crores. And with the strong receivables, I'm very sure that we will be achieving this particular number without any hassle, sir.
So can you repeat the last sentence what you have said, because there was some discrepancy and the voice got muted.
What I said was we have a very strong receivables. Number two, we have already gone for a debt funding in which 60 debt funding of 120 crores. Out of 120 crores, we have already got the sanction for 60 crore. The bank procedures are going on for the disbursements of the funds. And another 60 crores will be disbursed from another bank between 15th and 30th of this month. So sanction will be around 15th of this month, and the disbursement would be before the 30th of this month. That is June 2026. So we will be having another 120 crores of debt, and the receivables are also going to come. With these two things, we will be in a position to achieve our target without any hassle. This is what I said, sir.
Okay, thank you very much. And another one is, what is the overall R&D spend in FY26, and what are the plans for our R&D spend in coming years?
So thank you so much for asking this question, sir, because we have been doing this R&D activity in 26 in a greater way. Previously, it was around 4%. Now we feel that this can even go up to 8 to 9% this year, because we are expecting a lot of new product development and the technology transfers to happen this year. So this will definitely be increased this year for the greater good of this company, sir.
Okay, I have a few more questions, but I'll join back the queue.
Sure.
Thank you, Dhaval. We are taking a next question from Archit Agarwal of Step Trade Capital. Mr. Agarwal, please go ahead. Archit, would you please unmute your microphone and go ahead with your question?
Hello.
Yes, please go
Yeah,
ahead.
am I audible?
Yes.
Yeah. So my question is about the EBITDA margin. EBITDA margin has declined sharply from 25% to 20%. So can you elaborate like what factors contributed for this margin contraction?
Yes, sir. We have already highlighted in our call about the EBITDA margin, actually. So there is a very steep increase of raw material price, which everybody knows, particularly during the second half because of the war that has been happening, basically. So there was an increase of raw material price, especially aluminum, because our major raw material is aluminum ingots, aluminum extrusions, aluminum sheets and coils. So there was a steep increase of more than 80% of price for aluminum. And there was an increase of more than 30 to 35% of the, not even 30%, 60 to 65% of the stainless steel price happened in the overall last 1 year, basically, year-on-year comparison. And we have clearly highlighted that our raw material plays almost or more than 60% of the composition of our product, basically. So that has drastically disrupted our overall EBITDA margin. Even then, we managed by lot of cost-cutting method to compensate this particular losses, and we managed to have the PAT margin of 12.2%. When you talk about the PVC class, price variation class, which is already incorporated in the contract, that covers only to certain limit, let's say around some 60% or 50% of the overall losses. Rest of the 50%, when it comes to the raw material price, has to be incurred by us, number one. And number two, apart from the raw material, another 30-35% of the composition of the overall assembly totally depends on the accessories, like the glasses, rubbers, composites, fasteners, consumables, everything. This PVC coverage is not there. So we have to incur that particular losses. But we have very strategically managed this by blocking the price with the vendors, by giving an advance, by giving by creating this LCs and BGs in terms of price blocking. So by this particular method, we have already managed this particular losses, not to an extent of 80 to 90%. We have restricted to 20 to 25%, which is very great, basically, in my opinion.
Okay. Okay, sir. So my next question is about the joint venture with Big Bang Boom. So can we expect revenue in FY27 from this joint venture?
Sir, we are hopeful of getting the revenue from the Big Bang Boom this year. But as I told you already, that this is a 2-year program what we are doing with the Big Bang Boom.
Okay.
Meanwhile, there are certain good improvements happened with some other products also. As I said, like we will be exposing this over a period of time. So if something happens, then definitely this year we'll have a better revenue. Otherwise, definitely 2027-28 is going to be the good year. But we are expecting some revenue, but I cannot commit the numbers now. But there is some revenue expected this year, sir.
Okay. And out of this total order book of 469 crore, can you give the bifurcation? Like,
Yeah. So when it comes to the government and non-government, I would say around 415 to 20 crores is belongs to the government. And as far as the non-government sector, it is around 50 to 55 crores.
Okay. And do we have the
Archit,
defense?
sorry to interrupt. If you have any follow-up, please rejoin the queue.
Oh,
We
yeah.
have few more investors.
Yeah.
Thank you, Archit. We are taking a next question from Hitesh Sharma of Golden Sands Investments. Hitesh, please go ahead and ask a
Can you
question.
hear me?
A bit
Yes,
more
sir. Yes, sir.
feeble. If you can please come closer to the mic and speak.
Is it better now?
Yes, Hitesh. Please go ahead.
Very happy to understand your business and the way the company has been doing.
Thank you, sir.
And I just wanted to know, like, who are the main competitors to you, and which can be the impediments to the growth. I expect really a very, very high growth segment for me. This is the sector.
Yes, sir. So our major competitor would be Keneko, Hindustan Fiberglass Works, DTL, ancillaries, and Vidjar. These are all the major companies, and out of that, down south, we have a company called Universal Engineers. So these are all the companies who are competing with us, sir.
In the seating, there is a company from the France, which is or Spain. It is joined with the Tata.
Yeah.
Is it your competitor?
Obviously, for seating segment alone, we have two competitors. One is the Tata, and the other one is the company, a Korean company, the Tata. The Spain company, Spanish company. What you are highlighting, French and Spanish company. What you are highlighting is Finsa. Okay,
Yeah.
they have tied up. Yeah, they have tied up with
In
Tata.
Asia.
Sorry, sir.
Phoenicia.
No, that is
Phoenicia.
Finsa.
Okay.
It's called Finsa, actually.
Okay.
It's called Kampa Finsa. It is a company tied up with Tata. They are our competitors. Yes, Tata is our competitor for seating segment, for sure. There are another two competitors, one from Mumbai and one from a Korean company in Bangalore.
Okay, I'll be in touch with you separately as well. I'm adding a company which is making seats.
Wonderful, sir. Thank you so much, sir. Thank you so much for your support, sir. Thank you.
Okay.
Thank you.
Thank you. We have Sahil Garg of CCV Emerging Opportunities. Sahil, please go ahead.
Yeah, hi, good morning, sir. Can you hear me?
Yes, we can hear you.
Good morning, sir.
Hi, sir. You have earlier mentioned that you are looking to raise 120 odd of crore debt in this financial year. May I know what rate of interest the debt will be?
The debt is 8.25%, sir.
8.25%. Okay, so that means additional interest liability of 10 odd crores. Plus, you have mentioned that you are looking to increase R&D expense closer to 8 to 9% this year, right?
Yes.
So that's again like close to 45 odd crores. So that means a total additional cost burden of 55 to 60 odd crores in this year. So are you still sure, like confident to achieve the 12 to 13% PAT margin in FY27 on a turnover of 500
For
CR?
sure, sir. See, when we are investing on certain project, or when we are investing on certain R&D, we have a high expectation limits, basically. So if this particular expectation is met, then only we will be spending so much of money. Otherwise, for the regular railway activities, what we are now doing, we may not, we no need to spend money. We actually no need to spend even one single rupee on it. So we are expecting this margin for sure. And as I said, that we are participated in 1,200 crores margin. Tenders with a higher margin. The higher margin in sense like it's not just a higher margin basically because the tender what we have participated in the past, we're having a margin, a decent margin basically. But due to this escalations, we were forced to observe that margin into the system. That's why now the number 1,000 crore number what was promised during this March end was not being achieved for the betterment of the company. Because as I clearly highlighted in my note, that in terms of getting the order books, I don't want to compromise on the margin. So now what we are concentrating right now is basically a margin which is very decent. So that decent margin will obviously satisfy the requirement. And as I told you earlier, we are going to increase our cycle, the production cycle and the receivable cycle. The moment that is achieved, then probably that will be converted as a revenue basically, and then profit. So I don't think that we can reduce our overall PAT level less than 12% for sure.
And this R&D will be spent on aerospace and defense segment, or will there be any
Predominantly, sir.
Predominantly. And out of current order book of 469 crore, how much it comes from aerospace and defense?
This year, I said around 60 to 70 crores.
In the current order book?
Yeah, in the current order book, yes.
60 to 70 crores from aerospace and defense, right?
No. I'm sorry. So in the upcoming tenders, what we have floated.
That I got to know. I'm asking for the current order book. Like we have a current order book of 469 odd crores. How much it is from aerospace and defense?
So it is right now it is around 29 crores in the current order books, which will be executed this year. And we are expecting another 60 to 70 crores to be executed in this year through this tender process, which is predominantly through HAL. Okay. Other than this, I already said that whatever the tender we have participated through the defense portal and things like that, we have not included in the overall tender book itself of 1,200 crores.
So, sir, how long this R&D expense will help us? I mean, we are spending close to 45 to 50 odd crores in R&D on aerospace and defense, and we are only achieving a turnover of 29 odd crores this year. I understand that yes, there will be a big order when there could be a big order when like out of this 1,200 crore of bidding you have done. Like where do you see this? This segment to grow further, considering the amount of R&D we are spending in this year on this particular segment.
See, we are spending this percentage of 8% or 9% along with Big Bang Boom Solutions, okay, for making some electronic warfare systems, which I've already highlighted. So when it comes to the systems, since it is a defense product, it cannot be deployed onto the warfare straight away. The investment and the R&D will happen, and it takes some time.
Yeah.
More than that time, there will be a testing time or a trial time.
Right.
That takes more time. So what I am requesting you is to understand the defense sector, how it works. So it is not like a railway product where they wanted a new product within the 6 month time. We need to deploy the prototype, and then once the prototype is assessed and approved, then we go for the regular supplies. It's not like that. So this has to be at least deployed for at least a 6 month to 1 year into the systems. Once that is approved, and they will be taking into the army. Okay, this is how it works. So my request to you is that there are certain other areas which we are working. That is what I said in the previous answer, that we are expecting some other programs to happen faster, along with Big Bang Boom Solutions. Okay, so if that happens, this 60 to 70 crores will increase to maybe 150 to 200 crores also. Okay, so my request to you is that it is a very, very organic process. And definitely this process will work and it takes time. So my request to you is that we have to wait and watch on this particular program. There are certain inorganic things which, as I said, we are expecting. So that will be definitely a big surprises for everyone.
So, sir, what is the current margin split?
Sorry about this, Sahil. We have a few more participants waiting in the queue. Would you
Maybe a
mind
last
rejoining,
question.
please? I'm so sorry about that,
Okay.
Sahil.
Okay.
Please rejoin the queue for your
Okay.
follow-up.
Yeah.
Thank you, Sahil. We are taking a next question from Rudraksh Raheja of I Thought PMS.
Yeah. Thank you for the opportunity, sir.
Thank you, sir.
Yeah, I'm very, sir, new to the business, so my questions would be very rudimentary only. So, sir, there is a higher share of private business in H2FY26. Could you share more details on that? Is that a sustainable trend for us going forward?
Sir, actually, we are majorly focusing on the government projects. And we also are utilizing almost 90% of our capability right now. So what we are doing right now is that we cannot, since this Indian railway business is spread all over the country, we cannot set up the facility throughout the country to cater to the requirement of the zonal railways. So what we are doing right now is that we are creating a channel partners throughout the country, and we are executing the contracts through our channel partners throughout the country. So this is how it is going to be in future. See, when you see the end product, end customer, it is the Indian Railways, right? So for example, now I am sitting in Chennai. I am now getting a contract from the North Frontier Railway. Okay, I had to send my person to Assam to set up a facility there and to execute the contract in the North Frontier Railway, especially when it comes to the zonal railways. Okay, when it is ICF, MCF, and RCF, it is fine. But the major business is now going to come apart from what we are doing is from the zonal railways, which is the refurbishment activities. For any refurbishment activity, I had to set up the facility near to the workshop to make it happen. So what we have done is that we have created a channel partner system right now based on the region who are basically a railway suppliers, and made them as a channel partners, and we make them to participate on our behalf, get the contract, and we manufacture the product sitting in Chennai, and they execute the contract in the zonal railways. So thereby, in future, the major contract would be from the Indian Railways and metro segment, and also the high-speed segment, which we have recently entered into the high-speed segment also. We have got the contracts also, a small contract from the high-speed segment also, which is going to increase over a period of time. So these particular contracts are going to go high in future, but the end customer is the Indian Railways, because it is going to be run in the platform of Indian Railways. So for your question, yes, it is going to be increased over a period of time with the increase of the direct sale of railway business. So end customer is the railways or the defense, but it will be channeled through a various companies. The reason is that we no need to spend lots and lots of money onto the infrastructure, and then to maintain our profitability. This is the strategical method which we are now following.
Got it, sir. Sir, how does this model impact our profitability and working capital? Does it help us in any way?
Obviously, sir. See, for example, I no need to invest. I no need to park my EMD cost. I no need to park my bank guarantee. I no need to park my performance bank guarantee (PBG) and security deposit. I'll be saving, and I'll be saving on my infrastructure cost, overhead cost. So what all I may be doing is basically I'll give my percentage of shares to them, and they will do everything from their particular point, and I'll be billing to them, and they'll in turn bill it to the customer. Definitely, this will increase my profitability.
But we'll share some margins or profits with the partners also, right?
Obviously, sir, their margins and profit sharing of margin is very much limited when comparing to investment calls and this other cost, no, sir.
Got it. Got it. And sir, any other players are using this model in India?
I am not aware of this thing, sir, but this is one of the best model which we are thinking to implement, basically. Because the volume of business is so huge, you cannot upscale yourself within the short period of time, sir. Because when I'm achieving 500 crores, then I'm implementing this particular method, and this particular method will be of great use when we are growing to 1,000 crore company, because the order projections are so good that you can spread this, or you can create a supplier or a supply chain network, and only through this method you can increase your top line and bottom line, sir.
Got it, sir. Got it. Sir, next question.
Sorry about this, Rudraksh. Would you mind please rejoining the queue? We have few more participants here.
Actually, this was only one question, so maybe I can ask one more.
Sure. Manikandan sir, is this all right?
I'm fine, sir. I'm perfectly fine, sir. They can
Sure,
ask
Rudraksh. Please go ahead.
Thank you so much, sir. Sir, what would be the capex outlay for 27 and 28? And like, where are we spending most of our capex? Which segment? Defense, aerospace, and railways? The split between the three.
Sir, this is a very tricky question to answer, basically, because see, I can tell you the overall spending for this year. It would be approximately 30 to 40 crores will be spent on the year 27, 28, basically. That is for the next year, basically. For this year, we are majorly spending on the R&D part, and secondly, we have given a commitment last year that we will be setting up the infrastructure of minimum 50,000 to 1 lakh square feet of shed for manufacturing the railway and the defense activity, which will extend to at least 3 to 4 lakh square feet of shed. That is the focus this year, which we have already got the land, and now we are going to start the building. For which we are already discussed with our bankers for the working for the term loan. So it's already aligned. So this year, as we promised last year, we will be making this particular infrastructure development with the 14 acres of land.
So, sir, how much would we spend on this project, this infrastructure expansion?
Approximately around 30 to 35 crores, sir.
This will be in FY27, right?
Yes.
And sir, are we going to expense our R&D, or will it come on our balance sheet?
So it will be coming on our balance sheet, sir.
But you said that it may impact some 8 to 9% of sales. You said that we can will spend in R&D for this year. So I thought we were expensing that amount to P&L.
No, sir, this will be coming in the balance sheet, sir, for sure.
Got it. Maybe I'll take this offline.
Yeah.
Thank you, Rudraksh.
Thank you.
We'll have our next question from Falak Shah of Mavira. Falak, please restrict to 2 questions and then you can rejoin the queue if you have any follow-up ones.
Yes, thank you. Am I audible?
Yes, Falak, please go ahead.
Yeah. I just wanted to know about the incoming orders for our refurbishment segment. When are the orders expected? What would be the order size? And what would be the expected kind of margin profile we want to make from these?
Ma'am, thank you for this question. Actually, this refurbishment of the coaches is a separate segment. Around 26,000 crores is already been sanctioned for this particular project, and this will start coming right from this year. The initial allotment is basically around 25,000 coaches over a period of 3 to 4 years, which is very, very big. So we can expect the order to flow right from this year, and hopeful of punching orders of at least 100 crores this year through this refurbishment project. As far as the margin is concerned, definitely we will be maintaining this particular margin. Whatever the current margin we are having, we'll be maintaining it.
Okay. Thank you. And I had another question on the orders from HAL. Could you give us a little more detail as to what's the product profile for these orders?
It is predominantly, the order is predominantly for the AMCA, Advanced Medium Combat Aircraft. So we have already executed certain products as a prototype, which got approved. Now the regular orders are now going to come, which is big in volume. So we are hopeful of getting those orders since we have already approved our prototypes.
So correct me if I'm wrong, but I thought that the AMCA orders were no longer with HAL and they were given to a consortium of private players.
So, madam, you should understand that AMCA production we are not going to do because we are no way connected to the AMCA production. We are talking about the simulators and then G22 simulators, which we are now talking about. It's simulators, not the product, actual product.
Okay, okay. Thank you so much.
Thank you so much, ma'am.
Thank you, Falak. We'll have Subhajit Das of Clover Capital with his question now. Subhajit, please unmute. Yes, Subhajit, please go ahead.
Thank you for the opportunity and thanks to the management for delivering stellar numbers. My question to you, sir, is that somewhere in the past you had mentioned, this is the second time I am attending your call. Some 3-4 months back in some conference call you had mentioned that for FY28 we can achieve maybe 1,000 crores revenue and 150 crores PAT. So is it in line or what would you think it is? Can be a conservative estimate, something if you can throw some light for FY28.
Sir, in fact, if everything goes good, we can achieve 1,000 crores and 150 PAT margin even this year, sir. We are wishing for it. So we have a very long plan, and we are not looking back. We are very, very clear with the numbers, what we have thought, and our focus is towards that. For sure, we are moving forward for that particular number. For sure, there's no. In fact, we can increase more than 1,000 crores, not less than that.
For FY28, sir?
Yes.
Okay. And sir, you had mentioned that in last con call in 2 years your order book ratio between railways and defense is gonna be 50-50. So how things are progressing, sir?
Sir, we are working for that only. As I clearly highlighted last year also, our focus is towards that. We are moving towards that particular thing. Now, as I said, like our intention is to achieve 1,000 crores in the next year, considering these particular parameters. So definitely we are moving forward on it. This is our wish and our progress is towards that.
And sir, how about the new plant commissioning, which is a 14 acres plant? There was a in the pipeline that you are commissioning some 14 acres plant.
Yeah.
Some 50,000 square feet to 1 lakh square feet, if I'm not correct on the number front. So when
you
is
are
that?
right, sir. You are right, sir. You are right, sir. 50,000 to 1 lakh is what we are planning this year, sir.
Okay, so this financial year, this is going to be commissioned, sir?
For sure, sir. Yes, sir. This is the commitment which I have given last year, which we are going to do this year, sir. For sure.
Fine, sir. Fine, sir. Thank you, sir, for your time and wish you all the very best, sir.
Thank you so much, sir. Thank you so much, sir.
Welcome. Okay.
Thank you, Subhajit. I think we have Pranjal Nimbalkar of Nivesa. Pranjal, please go ahead. Yes.
Hello.
Pranjal, yes, please go ahead.
Yeah. Sir, I wanted to understand what role does Sudhanshu Mani plays in your company, and how much does he help in your R&D and everything related to getting orders or something like that?
Sir, in terms of R&D, of course, we take our team, our technical team, our engineering team plays a vital role on this R&D front, because we see the vision, basically. We see the vision of where we are going to be in the next 5 years. So based on our visionary, our team is already doing it. And we are steadily concentrating on that particular part. As far as Mr. Sudhanshu Mani is concerned, he is more like our advisor who advises us like what are all the areas where we need to concentrate and what are all the futuristic projects or the product which is to be envisaged, like the lightweight concepts, lightweight trains, and latest technology in the global scenario. So all these things, we are getting a great advice in terms of technology, future technology, and also in terms of negotiations and with the technology holders and things like that. He plays a vital role on this particular front. So Mr. Tilak Seth plays a vital role on our structuring, because he was heading the Siemens mobility. So he is now playing a vital role on structuring the systems, basically. So he is one of the pivot point, like Sudhanshu Mani, who are very much instrumental in our vision, basically. But the vision was created by us, and our young team is concentrating on it.
Got it. And so, in the last one, I was sure that you were talking something about Kavach and you were building something around Kavach system, which was like an integrated system on top of Kavach. I just wanted to understand the progress or like.
Sir, your voice is very feeble, sir. If you can just loud your voice, then that would be great, sir.
In the last one, you had mentioned something about Kavach, building a product which is like an integration of Kavach, or was going to be on top of Kavach. So just want to understand the progress or what has happened over there until now.
Sir, this integrated security systems is on a very good phase right now. We are implementing this in our systems, basically, and we want to showcase to the railways, and upon approval of this will be taken forward, sir. Because as I said, that it is an integrated system. It is a total security systems. It requires a lot of parameters involved into it. right? So we will be exhibiting to the railway board and RDSO on this. And as far as the system is concerned, we are already in a very matured stage.
And when do we plan to show it to the railway board? Is there a time?
This year we'll be exhibiting to them, sir.
Okay. And sir, regarding the deployment
Sorry
of
about this, Pranjal. Would you mind rejoining the queue?
sure.
Yeah,
Thank you.
please.
Thank you.
Thank you, Pranjal. Requesting all participants to restrict to 2 questions for now. We have Kush Bantia of Nikunj Brokers. Kush, please go ahead.
Hi, sir. Am I audible?
Yes, Kush, please go ahead.
Perfect, sir. Please go
Yeah.
ahead.
So I have a couple of questions. The first one is on the postponement of purchase of our machinery. So when are we expecting to buy, and is there any change of plans in buying the machineries, the kind of machineries we were planning to buy? And the second one is on the fundraise. So are we planning to raise funds through equity in near future?
Okay. So for your first question, sir, actually, we have already highlighted the machinery list in the exchange. Most of the machineries are from China. So now, very recently, in sense like during the January time, Chinese government have set a rule to get a end user certificate from Indian companies, which means that we have ordered machineries which is a high precision machinery. Anything which is high precision machinery, they need to get the end user certificate from the government of India, and they were restricting these particular machines to go to India. So they have highlighted the OEM have highlighted to give the end user certificate. We are in the process of getting the end user certificate, which is getting delayed. So because of that, these particular machines are not being procured so far. Number one. Number two, parallelly, we are also planning to go for a slight change in the machinery. The reason being is that the new development is happening for a lightweight interiors for rail coaches. For that, there are advanced machineries required. So we are now trying to take this chance of the delay. Thereby, we can avoid going for these particular machineries from China and to get some other machinery which is actually relevant to this current year and next year production, basically. So we are already working with this Chinese company, and we are given the mandate that it has to be supplied immediately. Otherwise, we are going to cancel the order. So these process is already going on, sir. We don't want to get into any of this trouble with the Chinese company. So we are waiting for it. Probably we are expecting this result this month. Once we are very clear with the results, then definitely we will come out with the notifications or the informations whether we are going for the same machineries or with the different machineries. So we don't want to get into any of the fund locking systems here by the Chinese government. So we are very clear. So once we get this result, we will be deploying this particular fund.
Oh, got it. And my second question was,
and for your previous question, sir, if it is required, we can also share the communication of the Chinese companies and their government procedures to the BSE.
so that's fine, sir. It's up to you. What all you want to disclose, we
Yes.
trust you here.
So the second follow-up, the second question, if you don't mind, I missed your second question.
So it was regarding the fundraise. Are you planning to do
Yeah.
fundraise?
So for this year, I can't say we don't require equity in future, but this year we are restricting ourselves to go to further fundraise through equity, sir. We are very much comfortable with the debt fund what we are going to get from the bank.
So will it be enough for our this big bang home JV?
No, for we are not raising any equity for that, sir.
Okay, I will again join the queue for the follow-up questions.
Sure,
Thank
sir.
you.
Right, sir. Thank you.
Thank you so much, Kush. We'll take a next question from Chirag Satia of Satia Investments. Chirag, please go ahead.
Good afternoon, sir.
Good afternoon, sir.
Congratulations on the fantastic set of numbers.
Thank you so much, sir. Thank you so much, sir. Please, sir.
Sir, just to understand on that 14-acre facility,
Yeah.
we already know that you have 7 facilities currently going on. So, will you merge this entire all these facilities into one unit, or this will be altogether a separate new unit?
Sir, out of the 7 unit, certain units are very small unit, which is discrete right now. So we are going to keep our major unit intact and to shift the unit where we are paying heavy rent. So our idea is to reduce maybe or to control maybe around 20-25 lakhs every month as a rent, and then we want to use this particular facility to start with, and followed with that we will be merging the smaller unit into the system basically. So predominantly we are envisaging only 2 unit will be there overall without any payment of rent in future.
Gotcha. Fantastic. So you'll have a lot of advantage of economies of scale as well.
Exactly, sir. That's the idea, sir.
Very nice. Now coming back to this point that this machinery IPO fund utilization of buying this machinery, you had an issue with this Chinese government. Now I see that your capacity utilization is already at 90%.
Correct, sir.
And you have given a guidance of 500 CR revenue for next year.
Correct, sir.
So assume that if this machinery doesn't come up or whatever, it may get delayed. How do you intend to achieve this 500 CR given that you are already at 90% capacity?
So right now we are using the 2-shift mechanism, sir. Previously we were not using it. After September we started implementing it, and after December we effectively started using the two-shift mechanism right now. So this 2-shift mechanism is effectively used for last 4 months, last year FY26 basically.
Yes.
So if we are using the same mechanism for the entire year, we can really manage this particular year with, as I said, that we are now going with a channel partner arrangement. So when we are going through this particular arrangement, I no need to effectively spend so much of expansion onto the infrastructure and machinery.
That's fantastic. So this 500 really looks practically possible. And in case if this new machinery comes, the revenue may pump up even more.
Correct, sir. You are right, sir. You are right, sir. We are equipped for that, and we have a very clear vicinity towards that, sir.
Fantastic, sir. One last point, I see in your results that you had mentioned that there is a formation of a subsidiary company to carry out electroluminescent dynamic display boards.
Correct, sir.
I just wanted you to throw some light on what exactly is this.
Okay. Sir, actually, of course, it's very premature to disclose the technology, basically. I will not discuss on the technology front because it has to be officially announced. So I will do that later. But this is predominantly on to the commercials and signages of entire railway network and towards the flexible electronics towards the aerospace activity, especially space activity and aerospace activity, sir. So these are the main area of concentration. It is called flexible electronics. In nutshell, I can say this is a flexible electronics where the electronics can take the shape of the body or the substrate. So it is a deep technology which we are now venturing into it, sir.
So you'll have any commercials this year?
In terms of sales?
Yeah.
We are expecting that, sir, because railway is our customer. So whenever we enter into the railway segment, it is not a long gestation period segment. So hopefully we are we are expecting something this year, sir, which is not highlighted in any of the numbers so far in terms of order books or in terms of the tender participated. But these are all the inorganic growth which we are expecting this year, sir.
Very, very nice, sir. Thank you very much for answering all the questions, and I wish you all the best. And I'm very, very positive about your company doing the numbers this year.
Thank you so much for believing us, sir. Thank you so much for your kind words. I really appreciate it, sir.
Thanks.
Thank you so much. We'll take all follow-up questions for now, and we request all the participants to restrict to only one question. So we are taking a next question from Sahil. Sahil, I think Sahil has dropped off. We'll move to Rudraksh for now. Rudraksh Raheja of I2F Rudraksh, please restrict to one follow-up question. Please go ahead.
Thank you again, sir. Sir, just one question on the JV that we are doing. Could you help us understand what kind of capex or anything that we'll spend from our side, and roles and responsibilities that we will share with Big Bang Boom Solutions?
Sir, we have committed to invest around 25 crores towards this particular joint venture activities, predominantly to cater two major segments, which I have already highlighted for the autonomous drones, which we have almost in the finishing of the design phase. And secondly, electronic warfare, which is the indigenous activity, which we are now working with other foreign partners. So the investment would be around 25 crores from our side. Jointly, the roles and responsibilities is basically this joint venture company will act as a technology company where it holds the technology, and the manufacturing rights of this particular technology will be given to Airfloa. So this joint venture company will be a technology holder, and the manufacturing rights for these particular products, whatever has been developed by the technology company, will be done by Airfloa Rail Technology Limited. So that is the agreement. So when it comes to the scope inside the joint venture company, there is no as such a scope between Airfloa and Big Bang Boom because it is a joint venture company. So the joint venture company wholly is responsible for the technology.
Understood, sir. Understood. Can I ask another question, sir?
Sorry, Rudraksha, we are only restricted to one for now.
Thank you.
Thank you, Rudraksha. We are moving to our next follow-up question from Pranjal Nimbalkar of Nivesa. Pranjal, please go ahead. Please restrict to only one question for now. Pranjal, please unmute. Yes.
Hello. So I wanted to understand your coverage product will be...
Sorry, Pranjal, we are unable to hear you. Please come closer to the microphone.
Can you hear me now?
A bit more louder, please.
Hello.
Yes.
So I wanted to understand this coverage product of yours. Is it very close to how Kavach 4.2 is getting deployed? Will the deployment be on the same manner?
No, sir. This is totally a different system altogether, sir. Kavach is more of a equipment which got fitted into the system, but this is something which can be secured remotely by sitting in a remote place. So it's no way compared to the Kavach system, sir. The existing Kavach system, sir. It is more AI-based remote access system.
So will this be deployed on stations, or like I understand it won't be deployed on the...
Sir, I cannot disclose this right now. Okay, so definitely we'll be in a position to explain about this separately. We will definitely do that because There's technology involved into it. There is a partner involved, technology provided partner involved into it. So I cannot disclose this now, sir.
Okay.
Sorry. Thank you.
Thank you, sir. Thank you.
Thank you, Pranjal. We have another follow-up coming in from Paras Cheda of Purple One. Paras, please go ahead. Please restrict to only one question for now.
Yeah, thank you. So I just wanted to know, with our current capacity and the new 14-acre capacity that will come up now, what peak revenue capacity can be expected over the next couple of years, and when do we likely achieve that?
Sir, we were talking about the top line this year, sir. Obviously, this particular top line this year, the infrastructure, what we are now going to do is not going to contribute much on the top line what we are doing right now. But for the next financial year, yes, definitely there will be a big support we are expecting from this particular infrastructure spending, sir.
So what kind of revenue capacity in terms of peak that can lead to? Not necessarily next year, but I'm saying just over a medium term.
So we are expecting at least the capacity of right now what we are having, the capacity is around 90% of the existing facility, and we want to double up this capacity with this particular new infrastructure, sir.
Understood. And for just next year, I mean, for FY28, do we need an equity raise potentially?
For FY28, we may need it, sir, but I cannot comment right now because it all depends on the maturity of the products. Because right now we are spending on the R&D, or we are investing on the R&D part. Once the R&D is matured, then obviously the actual business starts. The moment actual business starts, for sure the business volume will be very high because of the segment which we are now concentrating in. Those time, definitely there will be the requirement of funds, and it will be done through equity, sir.
Understood. Fine. Thank you so much, sir.
Thank you, Paras.
Thank you, sir.
We are moving to our next follow-up from Kush Bantia. Kush, please ask one question as a follow-up one, please.
Yeah, thanks for the opportunity again.
Yes.
So, my question is, if things don't go in our favor regarding our machinery thing which is going on with the China, then is it going to impact FY27 numbers, or and also as if we are already running at 90% capacity, so delay in that will we be able to achieve our FY27 target of 500 crore top line?
Sir, absolutely not. You can be rest assured that these particular machines, what we are now talking about, is actually the work is going on in a different process. So this particular machines are not going to affect our turnover for sure, because we have already got 2 machines, which is the primary machines out of this overall IPO spendings, right? So you can be rest assured that this particular mission activities are not going to affect our FY27 turnover for sure.
So then, if we are, as you mentioned, that we are running at a 90% capacity utilization right now, so we'll be able to do 500 crores this time, because I think in last call you already mentioned that we are already running at 2 shifts right now.
Correct. We are, sir. When you see the last calls, I say during the previous answers, I clearly highlighted that we have adapted this 2 shift systems for the last 4 months. That is for the financial year 2026, and we are going to have the same thing for the next 10 months. Now 2 months is already over, and then another 10 months, which means that from 320 crores there is an easy gap of achieving 400 to 450 crores easily with the same system. But now what we are adapting is basically the channel partner systems, which I have already answered during the last call also.
Yes.
That we are spreading our risk towards the other companies, and or I can't say the risk here, but the opportunity to achieve this top line can be through our channel partners. Means that we operate or we execute the contracts through our channel partners. Thereby, I no need to spend huge money onto the infrastructure.
We are just outsourcing few of our tasks.
Well, outsourcing is a supply chain management, which we are doing separately.
Okay.
But what I am trying to say is that the entire orders will be executed by us through our channel partners.
Okay. Got it.
Thank you, Kush.
Thank you, sir.
We have another follow-up question coming in from Subhajit Das of Clover Capital. Subhajit, please restrict to only one question for now.
Can you hear me, sir?
Yes, please go ahead.
So, sir, you had mentioned in the PPT that railway orders are a bit on the lumpy side. Can you just elaborate on that? And also last time you had mentioned that 40% of your orders get executed in the last quarter. So will that be the same, or it will be a more spread out even H1 H2, evenly matched H1 H2?
Sir, actually, not last year. If you see last 15-20 years, the trend is like this. This is the trend of the railways, right? So the trend is like this, but what we are trying to do is that based on our approach with the railways and the last time urgency and things like that, we are trying to distribute throughout the year, but we will definitely achieve to some extent, but the trend cannot be changed because it is majorly driven by the Indian Railways and other railway segments, basically. When it comes to the other customers like Siemens, Alstom, or even BEML, we have a very structured supply chain or the schedules, basically, in terms of supplies. There we are maintaining it on a monthly basis. There's no issue on it. But our major customer is the Indian Railways and other railway manufacturing companies, right? So there the trend is like this. We will try to, spread it all over. But as a whole, the trend will be like this only, sir.
And sir, what do you actually elaborate on the lumpy side? You said mentioned the lumpy orders. Means is it like very infrequent orders but very high orders?
I don't understand your question. Sorry, sir. Can you please repeat again?
Sir, sir, you mentioned lumpy orders. Is it like few orders, but those orders are very big in size, or something like that? Can you just elaborate on the lumpy side or the order book?
Lumpy orders.
Yes, sir. You mentioned in the PPT from the railway sector.
Oh, okay. So based on the PPT, okay. So what I'm trying to say is that you have a very big order books. Okay, in that you have the high profit margin orders.
Okay.
So that is basically being selected, and then we give importance throughout the year.
Okay. Okay. So that is your first priority.
Exactly.
So
surely. It doesn't mean that we don't execute the other orders because we have a guidelines, we have our delivery times and things like that. We will be doing it simultaneously, but we are spreading this particular order throughout the year.
Okay, sir. Thank you.
Thank you, sir.
Thank you so much, Subhajit. Ladies and gentlemen, due to paucity of time, we will take that as the last question for today. I will now hand it over back to Mr. Manikandan for his closing remarks. Please go ahead, sir. Mr. Manikandan, you can go ahead with your closing remarks for now.
Yeah.
Yes.
Thank you, sir. So, thank you for your continued interest in Airfloa and for joining us on today's call. If you have any follow-up questions or require any additional information, feel free to reach us at Atlas Capital, our investor relationship consultant. We appreciate your time, support, and continued engagement with this company. Thank you and have a great day. Thank you so much, sir.
Thank you. On behalf of Airfloa Rail Technology Limited, this concludes today's conference call. Thank you all for joining us, and you can now click on the leave icon to exit the meeting. Thank you all for your participation.